We are now going to proceed to the interactive live Q&A section of our webinar. I would invite all of our analysts to come on video now. And we look forward to hearing your questions. We'll go one at a time. I will call your names, and then you can direct your questions to the management team. First, we will begin with Lance Vitanza, our research analyst from TD Bank.
Thanks, Shirish, and thanks everybody for taking my questions. I'm going to see if I can get two in if I can. The first is, at some point, does concentration of Bitcoin holdings at a single corporation impede adoption of Bitcoin as a store of value, let alone other potential monetary functions such as medium of exchange or unit of account? And if so, when might that point realistically come for strategy? Is that 5 years out? Is it 10 years out? Is it longer? Is it shorter? Or is it just the wrong question?
I'm sure everybody's got an opinion, but I'll start. I think we're accelerating institutional adoption, but we're also accelerating the adoption of Bitcoin, just like BlackRock is accelerating the adoption of Bitcoin because we're channeling new forms of capital into the ecosystem. And you couldn't, there's whole sets of capital that wouldn't come into the ecosystem if they don't have an investment grade, credit-worthy counterparty to trade with. So we don't really think there's any number. We're up to 3% of the system. I mean, it's getting exponentially harder. I've said, before, it feels to me like if we get to 5%, Bitcoin's going to be $1 million a coin. And if we get to 7.5%, it's going to be $10 million a coin or some ridiculous amount. If it does get to $10 million a coin, and if we do get to 7.5%, that will mean that 93% of all the Bitcoin is held by somebody else somewhere, and that will cause an explosion of innovation in the rest of the world. For all we know, right, the harder we try to acquire it, the more it will decentralize to other places, because you're going to see an explosion of other innovation because everybody else that's not BlackRock or not us or not whatever is going to have all this Bitcoin that's valued at millions and millions of dollars a coin.
And then just as a follow-up, and Phong, you touched on this, that you've been actively encouraging other public companies to follow in Strategy's footsteps and create their own Bitcoin treasury models. Are you worried that you may have been too successful in making that pitch? And at what point does the plethora of public Bitcoin treasury companies, or PBTCs, as I like to call them, at what point does that become a problem for you, either in terms of access to capital or potential for bad actors, et cetera? Thank you.
I can start. I don't think we get to that point. I think the positive of more Bitcoin treasury companies is creating knowledge. As you can see, we're quite understood. And so the more companies there are, the more analysts will cover them, the more retail investors will get involved, the more institutional investors will get involved, the more large banks, and the more there is just knowledge about, for example, how to value a Bitcoin treasury company. And I think we're pretty far from understanding that. Second piece, if they're all buying Bitcoin, Bitcoin price is going to go up, which causes our Bitcoin net asset value to go up, which causes our equity to go up, which causes our ability to raise more capital. I don't think we're even close to a place where this capital markets and the credit markets for Bitcoin are saturated. I think we're in the first inning of a 9-inning game, and I think more and more access will occur. And I think they're all, getting started. Look, a lot of these Bitcoin treasury companies are markets that would be very difficult for us to access. Bitcoin treasury company in India, Bitcoin treasury company in Sweden and Brazil. So I think they're all additive. They're all accretive right now. And I think they all have their own niche strategy. And look, they're not really close to us in size, right? The place at which they can issue innovative preferred securities might be 2, 3, 4, 5 years out. So even if they did, it's going to take a while. But I think they're great.
And I would say we're not all, the Bitcoin companies aren't competing with each other. We're competing against 20th century credit instruments for the most part, if you think about the fundamentals. you're competing against corporate bonds and preferred stocks, illiquid bonds, illiquid preferred stocks, illiquid credit that is generating normally a 400 or 500 basis point yield. And all these BTC companies are in a position to create digital credit that generates 400 basis points more than the risk-free rate in all their own markets. And, that's hundreds of trillions of dollars. So the real competition is between the credit instruments that come out of the BTC ecosystem versus the credit instruments that are backed by real or yen or euros or rubles or naira or dollars or whatever the other source of credit is. So that's another way of saying we're all very cooperative. It's good, the more of us there are, the more of those capital markets we can provide a digital solution to. And then the other point, coming back to your first question, is, if you want to sell $100 billion worth of investment grade credit to insurance companies or pension funds that are conservative in the United States, you're going to need a big Bitcoin treasury company to do it. And if you want to sell an equivalent type of credit in Germany, you're going to need a German operation or a Japanese operation to do it in Tokyo. So what's really happening is the digital transformation of credit type assets. They were either backed by, some currency derivative or some kind of, what backs a junk bond? Like the effort of a struggling company is what backs a junk bond. And so we're replacing that with something better and different. And so companies at all scales are needed. You need a monster Bitcoin treasury company in Japan. You need a big one in France, a big one in Germany. But there's always going to be home court advantages and national champions. And the way that we all cooperate is we're all competing for the same 450 Bitcoin a day. And once you bought the 450 Bitcoin, the price of Bitcoin has got to move up, increasing the collateral value of everyone in the ecosystem. And as the collateral value increases, and the other thing we're doing is we're damping the volatility. As we increase the collateral value and damp the volatility, the BTC risk numbers plunge, the leverage increases, and you can imagine you can create a lot more of this BTC-backed credit, which is just a very positive feedback loop. And so we're in a virtuous competition or virtuous cooperative cycle with any company that's capitalized on a Bitcoin standard anywhere in the world.
Thank you, Lance. Next, I will invite Lyn Alden.
So thank you for the opportunity. So Strategy navigated the 2022 bear market successfully. And so my question is going to relate to stress testing as it relates to these midterm BTC ratings. Given the strategy's credit products are backed more by assets and capital access than operating cash flows, are there certain Bitcoin bear market assumptions or thresholds, either such as in terms of drawdown magnitudes or lengths of time where capital markets might become inconducive for new capital issuance, that you're planning for as you design these forward leverage ratios and for your overall capital structure? Thank you.
I think that if we equitize the convertible bonds and we go to all preferreds, you can imagine, for example, you have $100 billion of Bitcoin, you have $50 billion of preferred in an extreme, like the extreme case, a 50% leverage case. And if that $50 billion was a debt liability coming due in 3 years, that would be a lot of risk. And if it was a debt liability coming due in 25 years, it'd be less risk, but it'd still be something. But if it's actually equity, if it's $50 billion preferred equity, it never comes due. And so now you have a different kind of risk. In that particular case, Bitcoin can draw down 80% and you're fine. It can draw down 90%. So I actually think if you look at our structure, as we migrate to preferreds, we end up with this, very, very robust anti-fragile capital structure where the principal never comes due. And then you have to ask the question, well, where is the liability? and the liability is in the dividend. You notice when Andrew showed the liabilities, he showed you three tranches. He showed you the interest liability, the cumulative liabilities, and the non-cumulative liabilities. That's because the interest has got to be paid or you're in default. The cumulative doesn't have to be paid, but if you suspend it, it accumulates, so it's still a liability. And then the non-cumulative, you could suspend it and it isn't a liability. So when you add all that up, you imagine that you've got $50 billion and you have, even if you had a 10% dividend, that means you're down to $5 billion. So on $100 billion of assets, you've got $5 billion of dividend liabilities, but some of them are more collapsible than others of them. But so you say to yourself, well, what happens if Bitcoin falls 95%? You'd still meet those liabilities most likely. You might in a 95% drawdown, you might suspend something. But you can see, for the most part, no one really contemplates, more than the 80% extreme craze case of the crypto. Well, I guess the crypto winter is like 75% or something. You would know 6,000 to 16,000, I guess, was like the peak to trough. Call it 80%. I think that our structure is smooth, and we wouldn't miss a single dividend payment on an 80% drawdown. On a 90% to 95% drawdown, in theory, you might suspend something for a little bit of time, but you would eventually get back current on it. So, so I think in terms of robustness, it's pretty robust. And if you compare it to the fragility of a conventional bank, think about the leverage we've got in order to generate our earnings. We've got maybe 1.2 leverage. Typical bank's got 10, 20x leverage to get their earnings. So this model is orders of magnitude less risky than a conventional banking model. Phong, Andrew, do you guys have anything to add on that?
I can add, Lyn. We've had the benefit of being a Bitcoin treasury company for 5 years. We went through a crypto winter in 2022 with a much more fragile debt structure and capital structure. We had a Silvergate margin loan that was Bitcoin backed. We had a secured note that had onerous clauses, and so we learned a lot from that. And at that point in time, our most pristine debt were our convertible notes. And now I think we're much more prepared for Bitcoin drawdown, because over time we already don't have secured notes. We don't have a margin loan. Over time, we may not have convertible notes. And to Mike's point, we will be relying on perpetual preferred notes that don't ever come due. So I think we learned a lot during this period of time, and we hope to share that with everybody out there.
Thank you.
And of course, the point is we did survive the 80% drawdown with a much weaker capital structure. So this capital structure is bulletproof compared to that one. So I think we're good to 90%. And if it goes below 90%, then we'll shuffle a few things around. It'll be colorful.
Great. Thank you, Lyn. Next, I'll invite Samson Mow.
Sure. First, just a quick comment. 0.15 M by end of year is very conservative, but I think you have to use what the analysts are providing. But my question is, the preferred shares, they have a BTC/credit rating ranging somewhere between 3 to 9 or 5 to 9. How effective are those preferred at generating yield, assuming we have periods of crab market? Like, it seems after a 1.25x increase in Bitcoin price, you might have to wait some time before you buy again. And in what conditions would you increase that or relax it a bit to go above 9 or above 10?
If one of the interesting things is right now, you can see from all of our credit models, the credit is all undervalued. Like the marketplace doesn't appreciate the credit very much. So over the next 36 months, you would think that the drivers of our credit strategy will be education of the market. You know, just getting out and talking to people and educating them on our credit models is a big plus. Every time we do an IPO, you've noticed the first IPO was a little bit smaller than this, or more difficult than the second. The second was easier. The third was double that. The fourth was more than double that. So every time we go back to the market, we educate more people. We're educating credit rating agencies, and as the world's view of Bitcoin as collateral evolves, that makes it easier. So, as a general trend, the direction of travel is the world is getting more comfortable with Bitcoin-backed credit, and that makes our strategy easier. Let's assume that Bitcoin chops sideways. You know, the negative is that the collateral value doesn't go up, but the positive is if you actually look at the trailing 30-day BTC vol, it's low. It was like 20 the other day. So when the market chops sideways, the volatility of Bitcoin falls. And you can see one of the most important drivers, you know, in Black-Scholes and the important driver in our risk models is volatility. So we're kind of winning when Bitcoin is surging up because we've got a lot of collateral and a high BTC rating. But we're also winning. If you go and you play with our model and you crank vol from 40 to 35 to 30, and I just showed you an example, you know, if it falls 10 points, stuff that looks like it's high yield becomes investment grade. And so I think our credit strategy might benefit from Bitcoin trading sideways for a while in a counterintuitive way. And for the most part, we're really competing against a bunch of people that don't know. Like the Wall Street Journal is running an ad, high yield savings accounts. You can get 3.6% interest from such and such bank, you know? And there's a world of people that are, by the way, if SOFR falls, if the Fed, you know, changes policy, those banks will be yielding 2%. You know, your bank account will be 2 or 1.5%. We're out there educating the retail market that there's something better than that. And I think that our credit strategy right now is primarily driven by educating institutional buyers, educating retail buyers, educating credit rating agencies, and having the world embrace Bitcoin as good collateral. And at the point that JP Morgan and somebody else starts to accept it's good collateral, then I think people come back and look at our credit and they re-rate it and they say, oh, actually it doesn't deserve a 600 basis point credit spread. It should be a 200 basis point credit spread. So I think that all of those dynamics actually overwhelm whatever the price action is of Bitcoin in the next 24 months to 36 months. Any of you other guys have something to add?
Heads you win, tails you win.
I think the important point is when Bitcoin is highly volatile, it's very good for our equity. And when Bitcoin, you know, people go, aha, what happens when Bitcoin's not volatile? And what they don't realize is if you take that credit model I showed you and you crank in 20 vol and all of a sudden we fall to 20 or 25 vol, you can go to 90% leverage. Because you know, the credit looks like investment grade at 90% leverage. Bearing in mind, by the way, that banks that are issuing preferred stocks we compete against, they're 20x levered, right? They have $20 of a liability for every dollar of equity, and they're paying 5% or 6% yield, and we're offering 9%, and we're not. So really, this all comes down to educating the 20th century market about why this Bitcoin-backed credit is better. And that's a fundamental thing that overwhelms, I think, the near-term volatility or lack of volatility or price change in BTC itself.
All right, thank you.
Thank you, Samson. Next, I'll invite Brian Dobson, a research analyst from Clear Street.
Yeah, thanks very much for taking my questions. So the Trump administration has made some very positive regulatory changes for Bitcoin. If you had your way, taking a big picture view, what would be the next area of improvement for regulators?
Yeah, my opinion is it would be beneficial to the market if they nail down the digital assets taxonomy. You know, under what circumstances can you tokenize a security? What's a digital security? If they can clarify a digital commodity, what's an asset without an issuer versus a digital token? If they could clarify token asset class dynamics, what can I create a token and is it less than a security and different than a commodity? I think there's a lot of murkiness around all that, and they're supposed to be dealing with in the Clarity Act in September. I think that will create a very rich framework for the entire crypto industry. And I think absent that, there's going to be a lot of confusion about the difference between tokens and commodities and securities and you know who can issue what and how long it takes. And you know, in the ideal world, 40 million businesses would be able to issue a token in 4 hours for $40. You know, and in the current world, it takes you a year to issue a public security. You know, minimal, maybe 2 or 3 years and 40 million bucks. And we might end up in a world where we're half in the middle, which is, oh yeah, it only takes 6 months and it only takes $2 million to create a quasi half, not security, you know, on the way to being a crypto commodity, but not really for the next 2 years. And if that's the case, you won't have really achieved the full potential of the industry. And so I think that we've still got a lot of uncertainty around that needs to be resolved.
Yeah, great. Thanks. And then just as a quick follow-up, you've had some very successful offerings this year. Could you share any kind of feedback that you've gotten from the buy side regarding those offerings and what kind of securities could we see the firm offering in the future in addition to the ones already on offer?
Phong or Andrew or Shirish, you guys want to start?
I can jump in there. I would say that, we launched our first perpetual preferred early this year, and there was a lot of I would say analysis and price discovery and just trying to get an understanding of that innovative instrument. I think ever since then we've shown a track record of growing demand on every subsequent IPO. We've seen institutional demand increase deal over deal. We've seen retail demand increase transaction over transaction. We've also seen high net worth individual demand. And so I think what we're doing is we're providing opportunities to different aspects of the market that haven't existed before. And I expect that there'll be more interest. STRC just recently got listed on NASDAQ. I think it's the most innovative treasuries, Bitcoin treasury security out there. I think we'll start to see more retail demand, more institutional demand. So I would expect that those existing securities will continue to season and mature and grow. And as for other types of opportunities, other offerings, I think we continue to focus on this preferred equity segment. We have opportunities to take our existing type structures and deploy them internationally. That's something we've talked about in the past to different markets and different currencies. And then we're building out a bit of a Bitcoin treasury yield curve. And right now we've got long duration, we got short duration, and as everyone knows, there's maturities everywhere in between. So I think we have a lot of opportunity to grow and potentially explore new areas as well.
Great, thanks very much.
Thank you. Next, I'll invite Preston Pysh.
Hey guys, congrats on the amazing results. I think you guys are at a really monumental point right now, especially considering you guys have been exercising this strategy since 2020. The performance has been in excess of that of NVIDIA, and you've become of a size that it's near impossible for people on Wall Street to really kind of ignore where you're at right now and what you're doing. And if I was just going to try to capture what that is, it's you're arbitraging the difference between Bitcoin's annualized return of, call it 45% versus the 10% that you're paying out in the preferred market for a 35% delta. Michael, you just mentioned that one of your biggest challenges is the education side with institutional investors. And I think from the outsider's perspective, they're looking at what you're doing and they're looking at all this preferred issuance and they're saying, oh my God, there's so much perpetual drag that's going to be on this company that's going to bog it down. If Bitcoin goes down 50%, it's going to have all these types of issues, which by the math is, just not true. But what are the steps that you're taking to kind of overcome this education burden that continues to persist and continues to be a problem in the Bitcoin space in general? Yeah, that's all I got.
Phong, do you want to start on that one?
Yeah, I'll start with, Andrew mentioned it, in January this year, we started working on Strike, and we had to educate every investment banker and every convertible note banker and every preferred banker. And it was like a knockdown, drag out 2-month process, all of our accountants, all of our attorneys. And then we issue Stretch 6 months later in about 2 weeks, and everybody gets it. And that's the process. That's the process to educate people and we're going to go out there. Mike is very well known for all the podcasts he does, right? I'm becoming more public. All of you are doing an amazing job out there. It's a process, but the more people figure out, the faster it goes. And, most we're selling preferreds now to people who've never even heard of a preferred. Right. And we sold almost $600 million of preferreds to retail investors who just see a 9% dividend yield, twice as much as what a money market gives you, 10x over, more than 10x over collateralized. And they're like, oh, and it's overnight money. So I'm going to take the money that I was going to use to send my kids to college 6 months from now or whatever it is. I'm going to put it in there, sit it there, get 10%, and then use it 6 months from now. I mean, innovative products will start to sell themselves, but I think there's a market out there, and it's the stuff that Jeff and True North and everybody's doing. This is how the word gets out, is viral. That's why we're doing this investor relations, digitally transforming investor relations. That's why we have you all here. People will learn. The great thing is good products, great products. It's not much different than the iPhone. Right? A great product, when someone first looks at it, may not realize how great it is. 2 months later, it sells itself by word of mouth. And I think people will get educated. And bankers are making fees. We're the largest IPO this year. Guess who makes money off of IPOs? Bankers. Guess what bankers like? Making money. So they figure this out pretty quickly, right? So I do think the market will figure this out. And I think it starts with us. It starts with you. Becomes the banking community, the retail community.
I think if I could add to that, yeah, I think the product is important. To Fong's point, it's not just we're selling preferred stocks to people that never heard of a preferred. We're selling a Bitcoin-backed preferred to people that have never heard of Bitcoin, that don't even know what Bitcoin is, and we're even selling it to people that are afraid of Bitcoin. So, but if you walk down the street and you say, would you like a high yield bank account that pays double what your bank is currently paying? The answer is going to be 99% yes. The only question is, do I trust you, right? Do I like you? The car flies, and it's a electro hover car and it flies. Do you want one? Well, if my neighbor's got one and it looks safe, then of course I want one. So what we found is the key is to package the product, and then we've got to build a distribution channel with the banks, and then we've got to build digital education. So you can't knock on doors; you got to actually upload content. So we've taken to now we upload video content directly to hundreds of thousands of people, which is another thing, and conferences, right? These Bitcoin Treasury Company conferences. One part of education is helping companies become Bitcoin Treasury companies and figure out what it means to capitalize on Bitcoin and how to issue BTC-backed credit. Another marketing strategy and education strategy, Preston, would be, outreach to the credit rating agencies and the creation of credit models. And what I just covered here in my voluminous comments, which took too long, was I talked about an equity model, right? I laid out, an equity model. How do you create leverage and an MNAV of 2, 3, 4, 5? And then I also lay out a credit model rooted in statistics. And then we share that with the world. We open source it. And so I think that's part of it. And then I think the other part of it is the outreach to investors. And that means going to a lot of investment conferences and uploading a lot of investor content. And you can see an evolution in our presentations like the one today. We're spending a lot of time identifying the total addressable market for short 1-month duration credit investors versus high yield 5-year duration credit investors. And so we start thinking about that, and we've broken down, the markets in Japan, the markets all across Europe, the markets in the US. And to Andrew's point, the question is, do we want to sell, a particular instrument in 6 different currencies? Do we want to sell the same instrument, but at 1 year, 3 year, and 5 year tenors? Do we want to package a convertible instrument? And it all comes down to understanding the customer. It turns out that the investors are all different, and they're different everywhere, and there's many, many channels to reach them. So I don't think there's one answer, but I think that the success of Bitcoin is getting people's attention. And I think that when you give them a compelling product they want, that gets their attention. And then pretty soon you get like the money magazines and the financial reporters of the world. If Wall Street Journal is going to write an article about high yield bank accounts that give you 380 basis points, then presumably at some point the Wall Street Journal will write about, stretch type securities that give you 900 basis points. And I think that we got to let the market do its thing.
Phong, you should go on Preston's pod.
Thank you for your answer.
Thank you, Preston. Next, I'll invite Mark Palmer from Benchmark.
Yes, good evening, and thanks for taking my question. One of the really attractive elements of Bitcoin is the fact that it is trustless. You can look at the Bitcoin blockchain and know what transactions had occurred on it. Along those lines, we have seen at least one company move toward proof of reserves as part of their Bitcoin treasury strategy. Insofar as you're looking to get incremental trust from investors as you build out your capital strategy, would proof of reserves be an element that would make sense for the company at this point?
Phong, do you want to take that?
No, I think you can take this one, Mike.
Okay. We're studying it, and we're working on responsible ways that we could provide that transparency. And we're considering it in the context of our audits and our own security issues and controls and the scale of our operation. We just had a famous example of a concern, which is 80,000 Bitcoin got transferred to Galaxy, who then sold them. And everybody in the world knew that the Bitcoin was moving, and they knew where it went to, and they knew who was dealing with it, and they knew when it happened. And it created a massive dislocation in the market, like $3,000, $4,000 dislocation, and people lost their minds. We would like to not be in a situation where a routine custody reshuffling creates the same degree of chaos and dislocation, because when you're a large multinational, you do a lot of stuff for a lot of different reasons, and if everybody on Twitter is or on X is obsessing over every time something moves from wallet A to wallet B for any particular reason, it could be let's say counterproductive. So as we would always point out, you can't really hold the security unless you trust the auditor, trust the management team, trust the board of directors, and trust the processes. And then the auditor's job is to audit the assets and the liabilities, and then make sure that there are no side agreements, no related party transactions, and nothing else would undermine the integrity of that audit. So that's a much higher degree of transparency in the capital markets than simply publishing a single wallet address. So I think that at some point, if we can find a way to do it in a way that doesn't introduce other operational security issues, we're open to it. It's just it's a complicated thing that we need to consider very carefully.
I would just
Sorry, I was going to add, I do get the irony of people wanting to access Bitcoin for its decentralized, transparent nature, and then buying Bitcoin-backed securities through a U.S. public company. But what we do and what we provide on top of Bitcoin and we laid out is with MSTR, we provide superior performance through intelligent leverage. With our preferreds, we provide the ability to get pretty good dividend yields with a lot of downside protection. And part of the price of that is you're working with a U.S. public company that has Bitcoin behind it. And we have 15 people working on this. Could you imagine if we had to take 2 away to work on proof of reserves? You wouldn't get Stretch, you wouldn't get Stride, you wouldn't get Strike, you wouldn't get all this other product innovation. That's where we're focusing our energy right now. But it's not lost on us that we could find ways to do something to improve the transparency. That's why we do these earnings calls. That's why I do all these conferences, right? We do want to be a transparent company. That's very important to Bitcoin. And maybe we can get to a way we can provide proof of reserves without exerting a ton of energy and without creating a security risk for the company and for ourselves.
I was just going to add, we've been a public company for 27 years. Our internal controls process is robust. We have 2 big audit firms that we interact with. So, if you want to think about who other people use, we have 2 of the big 4 that look at, our information or our data and our tie-outs on a quarterly and annual basis. So while they might not be out there publicly, I think you take into account what Michael and Phong said. We are, one of the longest standing public companies out there. And, we rely on our mature internal controls process internally, as well as our external big 4 audit firms.
Very good points. Thank you.
Great. Jeff Walton, you're up next. We saved you for the last.
Great. Yeah, everybody could ask all the questions before I went. That was perfect. Thanks for having me. Honored to be here. And my question is very similar to Lyn's, but a little bit different framework. Given that Bitcoin and MSTR volatility is near multi-year lows, and Strategy has historically targeted a 20 to 30% leverage ratio during the convertible bond era, how does Strategy team now think about future volatility, leverage, and do you anticipate revisiting your leverage framework, reflecting the difference in preferred leverage characteristics and understanding the goal of retiring the convertible bond dated liabilities?
What I would say is 20 to 30% leverage is appropriate if you have a mix of bonds or mostly bonds on your balance sheet. But if you eliminate the bonds, which come due for cash, if they're not in the money, and you replace them with a preferred equity, then clearly it's reasonable to go beyond 20 to 30%, and you could look at 30 to 50%. I don't think it's appropriate to say we've changed that target range now because we still have $8.3 billion of convertible bonds. But what I think is over time, as we go to a preferred credit strategy, then the world opens up and we can take on more leverage. And the amount of leverage we can take on will be a function of the credit instruments. If we go to pure, for example, if you were non-cumulative credit, you could even take more leverage than cumulative credit, right? So the nature of the credit instrument will determine that, and then the volatility of Bitcoin will also determine that. If you're at 50 vol, you have a different view toward what that should be versus at 30 vol. So I think those will be part of our calculus each year for the next 10 years, and we will evolve. I don't know if we'll evolve quarter by quarter, but we'll probably evolve year by year. We generally do. And as for the volatility in the stock, I think the volatility is going to come back. We're going to see a lot more performance and volatility in the MSTR stock for a couple reasons. One, the equity guidance we gave, if we take a more programmatic discipline view toward using the MSTR ATM, then I think there'll be more volatility in the equity, because now there'll be more value in out of the money calls and things, right? Like if you thought the company was going to sell MSTR at $500, you probably wouldn't want to buy a $600 call option, right? So I think that our equity guidance will probably be very positive for the options market and for the shorter term traders that have an impact. And then I think that the acceleration, the transformation from bonds to preferred will also have a positive impact. And then I think the acceleration of our credit strategy via the preferred ATMs will have another impact. And I think the wild card here, Jeff, is I think that stretch is our iPhone moment. I really think that if you think about products we have, if I literally show people that the convertible bonds are mispriced and trading 40% cheap, and then I show you there's an 800 basis point unjustified spread premium, and people blink and nothing happens. And then nothing happens because nobody can buy that stuff, right? So the convertible bonds clearly were not our iPhone. And on the other hand, Stride, Strife, and Strike are breakthrough revolutionary instruments, but they're complicated and they're long duration. And if I saw a retiree, who said, what do you have? And I said, well, you can get 5% yield or 5% more than your bank account if you buy Strife. And if it was trading 122 and then it dropped to 116 the next week, the person would be really pretty, anxiety ridden, because, having 5% or 10% change in the principal when you're getting a 5% credit spread isn't really a consumer thing, right? That's too much of a roller coaster for them. So I think that the idea of a consumer product is, what's the product that you can offer anybody any day of the week for the next 10 years, regardless of what the stock is trading at? If the stock is trading at 10 MNAV or 1 MNAV, right? That's a MSTR equity roller coaster. And if Bitcoin all of a sudden rages up to 500,000, and someone's saying, well, should I buy this instrument or not? It's like there's a roller coaster. But if I'm saying that we've stripped down to a 1 month duration and it pays 500 basis points above your bank account, it's always going to be trading, hopefully, in our range. We're going to hope and expect it trades around to 100 plus or minus a quarter or something, and it's always paying more than your bank account. And if people see that and they see liquidity, then in theory, I don't know why you can't sell. If you walk down the street and you asked 100 people, do you want high yield bank account? 99 of 100 say yes. And if you said, do you want this, 100-year long Bitcoin backed, senior, junior instrument, 1, 2, 3, 5 out of 10, or 5 of them might try to figure it out. And I know that's a long-winded answer, but the point is, if there's infinite demand for stretch, if it works, right? And we can't declare it's seasoned until 30, 40, 50 days after we've launched it. But if stretch actually, hits its par and it trades with low volatility, then you could, in theory, sell infinite, $100 billion of it, $200 billion of it, right? You could use that to have any amount of leverage you wanted. And then the question of how much leverage do you want? is really going to be a question of how rapidly does Bitcoin price appreciate and with what volatility, and then how rapidly do we roll out of the convertible bonds, and then how rapidly do we get embraced by institutional investors and credit rating agencies. And those are all things that we don't know in the future. But if you take all that in its entirety, wouldn't you think that the performance and the volatility is coming back into the equity? We got a plan for it, right? We got 3 or 4 different ways to get there, and maybe time will just do it for us.
Thank you. Torque adjusted.
Fully torqued Bitcoin.
Yeah.
Do we have any other questions?
Excellent. So thank you everyone for staying with us for more than 2 hours. This was awesome. This concludes the Q&A portion of our webinar. I would like to thank all of our analysts for their questions and the audience for staying with us. We had thousands of people watch it live and join us on different mediums.